how to prevent investment losses. Practical strategy. Nobody talks about this part. Everyone wants to know how to make money investing. But almost nobody talks about how to not lose it. And here's the thing, protecting what you have is just as important as growing it. Maybe more important in some ways, because one big loss can wipe out years of gains. So today, let's talk about real, practical ways to reduce investment losses. Not theories, not complicated stuff, just things that actually work. Understand why people lose money. Okay, first, let's be honest about why losses happen. Because a lot of it isn't bad luck. A lot of it is predictable behavior. The biggest one, panic selling. The market drops 20%. You feel sick. You sell everything. Then the market recovers and you've locked in your losses for no reason. This happens constantly. Studies show that average investors earn way less than the market average, specifically because they sell at the wrong time. They get scared, they react, they lose. Second big reason, putting too much into one thing, one stock, one sector, one country. If that thing tanks, you have no cushion. Third, chasing past performance. Buying something because it already went up a lot. By the time most people hear about a hot investment, the big gains are usually already gone. Knowing these patterns is the first step to not falling into them. Diversification actually works. All right, you've heard this word a million times. Diversification. Don't put all your eggs in one basket, but let's actually talk about what it means. It means spreading your money across different types of investments, different companies, different industries, different countries, different asset types, like stocks and bonds, and maybe some real estate. Why does this work? Because different things go up and down at different times. When tech stocks crash, energy stocks might be doing fine. When US markets struggle, international markets might hold up. When stocks drop, bonds often go up. You'll never have everything going up at once, but you also won't have everything going down at once. And that balance is what protects you from catastrophic losses. A simple rule of thumb, no single investment should make up more than 5 to 10% of your total portfolio. If one thing you own dropped to zero tomorrow, it should hurt but not destroy you. Practical rules to follow. Here are some concrete things you can actually do. 1. Only invest money you won't need for at least 3 to 5 years. Short-term money in the stock market is risky. Markets can be down for months or even years. If you need the money soon, don't risk it. 2. Use dollar cost averaging. Instead of putting a big chunk in all at once, invest the same amount every month. This way, sometimes you buy when prices are high, sometimes when they're low, and it averages out over time. 3. Have a written plan before you invest. Know why you're buying something. Know how long you plan to hold it. Know what would make you sell. If you don't have a plan, your emotions will make the decision for you. 4. Check in, but don't obsess. Looking at your portfolio every day leads to emotional decisions. Once a month or once a quarter is plenty for most people. 5. Keep some cash on the side. Sounds boring, but having a cushion means you don't have to sell investments during a bad time just to cover an emergency. Investing isn't just about picking winners. It's about surviving the losses. Because losses happen, even to great investors. The question is whether you've set things up to handle them without it wrecking your whole plan. Diversify. Stay calm. Have a plan. Don't risk money you need soon. Keep some cash. These aren't exciting tips, but they're the ones that actually protect you when things get rough. If you learned something here, please hit like and share this with someone who's just starting to invest. It could save them from some really painful mistakes. Subscribe if you haven't, and I'll see you in the next video.